Hi everyone. In this demonstration, we're going to use the indirect method to prepare a schedule of cash flows from operating activities. In the yellow area is the problem in front of us, and we're dealing with the Pine Corporation. For the year ended June 30th, net income was $7,400, and we're going to go through the other facts and produce a schedule. Okay. The cash flows from operating activities always starts off with the net income figure. And we know from the problem it's $7,400. Then we have to add adjustments to reconcile net income to net cash. Okay, reading down, the first item we see is depreciation expense. Depreciation expense is usually the first item listed. It's an add back because it is a reduction in net income but not a reduction in cash, so we need to add that back to our schedule of adjustments. Accounts receivable increased by $4,400, inventories increased, prepaid rent decreased. Okay, what we're doing here is walking through the current assets. So at this point, I'm going to add a label and call it changes in current assets and current liabilities. We have the first change is accounts receivable. We have an increase in accounts receivable. And that increase in accounts receivable is $4,400, and as you know, if we held everything else the same, an increase in accounts receivable represents a use of cash. So to go from a net income basis to a cash basis, the change in the year resulted in an outflow of $4,400 of cash. Next, we have an increase in inventories. Again, this is the same logic since it's also a current assets. If it increased, we've got a use of cash. All other things being held the same, to go from a net income to a net cash position, if inventories increased, then we must have used cash to finance that increase. Next, we had a prepaid rent. It decreased by $1,400. So we have a decrease in prepaid rent and a decrease in a liability, a decrease in an asset indicates that all other things being the same, we must have taken in more cash when we start from a net income position. So in this case, decrease in prepaid rent in going from net income to net cash implies that we have a $1,400 positive adjustment. Now we have increase in accounts payable. If a liability increases and we're adjusting from net income to net cash from operating activities, then that means we were able to use somebody else's funds, is one way of looking at it. Another way of looking at it is we were able to finance our operations from someone else. So either way we look at that $14,000 increase in liabilities implies that starting from net income, we had a $14,000 positive change in cash flow. The exact same logic works for increase in salaries payable. And the last transaction we have is income taxes payable decreased. Okay. All right, now, again, if everything else was the same and we're moving from net income to net cash as a result of operating activities, and income taxes payable decreased, that meant we paid out more in taxes from the change during the year in taxes decrease required a cash payment to support that decrease. So the end result, if we sum all those changes, move that down one more, is 6,400 of adjustments to reconcile net income to net cash to generate the net cash flows from operating activities. Now, just to be on the safe side, we probably should label this in its full manner. And then we wouldn't need this row at all. I can simply, rather than delete it, just delete it. And that's the solution. Okay, so there is a rule that we used here, which is when we're putting together the adjustments to reconcile net income to net cash flow from operating activities, the rule is an increase in assets represents a use of cash and has to be shown in a bracketed amount. And you see that in these cells right there. We had an increase in AR and an increase in inventories. Now, when we have a decrease in assets, and I'll highlight row 19, you see that prepaid rent decreased. That results in a positive adjustment to our adjustments to reconcile net income to net cash flows from operating activities. Now, when we move over to the liability side of the equation, it works just the opposite way. An increase in a liability, an increase in current liabilities, that is, represents a positive adjustment, and a decrease in a current liabilities means that we must have used cash to support that decrease. Okay, everyone.